So the S&P 500 officially closed into a bear market on Monday, closing 20% below its peak. So what's next? Is it a time to sell in panic? It's going to get a lot worse. Or do we hold for dear life? Or is it a time to look for bargain opportunities and start buying? Let's discuss all this in this video. So in my previous video, I said that I expected a much stronger rally after this low that we made, this short-term bottom. I said I expected a market to go up to at least 4,000, right? 50% Fibonacci level or 4,361.8% level before we saw whether we would make new highs or we reverse back down. But it never got that high. The market just went up to the 38.2% level, consolidated, and then went back down again. So it didn't go up as far or as high as I expected, but it didn't matter because my traders and we still profited from this move back down. So the moment I saw the price action consolidating at the 38.2% level, couldn't break the resistance, and the moment I saw a breakdown, I said, here's a chance to short the market in the short term. So long term, I'm still bullish. I'm still holding my investments. But at the very short term, I said there's a chance we're going to go back down again. So I shared a trade alert with my students. I said, I'm going to short the S&P futures. So this was my trade alert on the 10th of June. And I said that there's a possibility that the market's going to go back down to retest those lows. I'm entering a bear put option spread on the S&P futures to at least get some short-term profits while the market goes back down. 3 days later, on Monday, I closed my short trades and took back about $14,000 in profits. So it's useful to do some short-term trades to get some short-term profits while waiting for my longer-term investments to rebound. Now, a lot of people, say, hey, Adam, you were wrong. You said the market's going to go higher, but it didn't. It went back down a lot faster. So, you were wrong. You predicted wrong. But the reason I'm sharing this trade with you is to tell you that as a trader, it doesn't matter whether you are wrong on your predictions. The point is that you have to be very, very flexible and adaptive. So yes, I expected the market to go a lot higher. I expected that. But the moment I saw the price action not going higher, facing resistance, turning back down, what did I do? I just shorted the market. So as a trader, your decisions to enter and exit your trades have nothing to do with your predictions. They got to do with the price action. So you got to be very, very nimble and flexible and adaptive to change on the fly. You have to change right away the moment the market changes its direction. Now, so am I still bearish in the short term? Do I still think it's going to go down in the short term? The answer is actually no. In fact, even though the S&P closed into a bear market officially, I'm actually bullish in the short term. Because right now we are way oversold. We are at extreme fear. And we have dropped more than 1% for 4 days in a row. And historically, whenever the market drops more than 1% 4 days in a row, and when we are at extreme fear, what happens? That's right, the market tends to bounce up again. So in fact, in the next couple of days, could be today, could be tomorrow, I expect a sharp bounce in the market. So in fact, in the short term, I may take a long trade to catch that bounce up again. So again, the point I keep making is this, that it's impossible to predict exactly where the market's going to go because there are too many variables, there are too many moving parts. Like, I didn't expect that the CPI data on Friday, when they announced the inflation, was going to be worse than expected, right? We expected 8.3%, they announced 8.6%, the market freaked out, and that's why it went down. Now, no one could predict, I can predict that. So again, understand that to be a successful trader and investor, our job is to not be able to predict exactly, because we can't predict exactly, but it's about following your trading rules and your investing rules. So when it comes to trading, I'm looking at the price action. The moment I see resistance coming down, I short the market. The moment I see support, reversal, I go long the market, right? So I trade based on the price action. Now, for my investments, again, more than 80% of my money is into investing. For investing, I don't really care about all these short-term ups and downs. For investing, I only look at the fundamentals of the businesses behind the stocks. As long as it's undervalued, it's a good business, I hold, I keep buying. So in other words, if you ask me, If I look at the markets right now, in the very short term, in the next few days, I'm actually bullish. I think that we're gonna do a sharp bounce. In the medium term, it could go back down again, right? Because we are in a bear market, so we could see a bit more downside. But in the longer term, which is a year from now, 2 years from now, I'm very bullish. I'm really bullish because, we know that, bear markets, so what? Bear markets don't last forever. Bear markets will end. They end in 2 months, in 6 months, or worse, they end in 1 year. But what happens after bear market? After bear market, you will have, hallelujah, the next bull market, right? So for my investments, I'm still holding them. I'm not selling any of my investments because they are good companies, and these companies will be worth double or triple in the next 1, 2, 3 years. I don't know exactly when, but they are really undervalued right now. So in fact, if you're in my community, you know that for my investments, I'm actually buying shares. But for my trading, I was shorting the market. So you could understand that to be a great investor and trader, you could be flexible. On one hand, you are shorting the market, right? Betting is going to go down using options. But on the other hand, you're buying stock because you know it's going to go up eventually, right? So we can all attempt to predict where the market is going to go. But ultimately, to be a successful investor and trader, it's not about making predictions. It's about sticking to your investment or trading thesis. All right. So I just want to make that point that you can predict wrong, you can get your expectations wrong, but you can still make money consistently. All right. That's the point I want to make. Okay. So with all that said, let me now go into some data. Right. So what happened, guys? What happened was last Friday, inflation was worse than expected. Okay. So everyone expected 8.3% inflation. We expected inflation to start to come back down. That's what we all expected, but no. Inflation came in worse than expected to show that inflation is re-accelerating. So the market freaked out. And because the market freaked out, we had this huge drop in the last couple of days. Why? Why did the market drop? Because the market is now pricing in the fact that the Fed has no choice. The Fed has no choice but to raise interest rates more than expected. So the Fed was expected to raise interest rates by 50 basis points for the next 3 meetings, right? So 0.5%, 0.5%, 0.5%. But now with this high inflation, the market is pricing in the fact that the Fed will raise interest rates by 75 basis points in the next 3 meetings. So 0.75, 0.75, 0.75, which will bring the interest rate, the short-term interest rate, to 300 basis points or 3% by the beginning of 2023. And the market is convinced that if the Fed does that we are going into a recession. So the market has already priced in a 70% probability of a recession. And that's why you are looking at all these headlines that everyone, the majority, are saying a recession is inevitable, or we're already in a recession, or we're going to have a recession, that we are, or recession, right? Now, the point I want to make for you is this, okay? So the market has gone down 22% year to date because the market has already priced in a 70% chance of a recession. The market has priced in the fact that the Fed will raise interest rates to 3%, correct? Okay, now, has it actually happened? Has the Fed raised interest rates to 3%? No. Are we in a recession? No. Are we going to see a recession soon? We don't know, right? So there's no recession. The Fed has not raised rates yet, but the market has really moved in a way that assumes it has already happened. Why? Because remember, the market tends to move 6 to 12 months ahead of the economy. The market tends to overreact, whether is it to the downside or to the upside. The market tends to overreact to bad news and overreact to good news. It's kind of like back in school. I remember that, back in school, even before we went for the final examination, before the exam started, we were like freaking out. We were like nervous because we think of the worst scenario. Like, I can't remember what I studied. I'm going to fail. I'm going to die. The question's going to be so difficult, right? And so before the exam started, we already freaked out. We already had our stomach churning. Same thing happens in the markets. Even before the actual recession, even before the actual rate hike, the market has already dropped. It has already freaked out. It has freaked out already. But did you notice that when the examination actually started, you didn't get nervous anymore because you found that, hey, the exam questions are not as tough as I thought. Like, I'm not going to die. I'm probably going to at least pass. And that's when your confidence comes back and you feel good again. And you're thinking about the holidays after the exam, right? So the same thing happens in the markets. So a lot of people are fearful now. They're saying, the market has come down so much. And if we go into recession, it's going to get worse. No. So what I'm telling you is this. What I'm telling you is that the market has already gone down, pricing in a recession, which has not happened yet. Now, if the recession does happen, by the time they announce the recession, guess what? The market would already have bottomed or near bottom, or the market would already have gone up. And if the economy doesn't go into recession, and it's kind of like the exam was cancelled, there's actually no exam, you freaked out for no reason, the moment that happens, the market is going to have an explosive rally and the bull market's going to start. Now, exactly when, I don't know. Could be the second half of the year or could be the early part of next year. And also, the market's pricing in the fact that inflation is never coming down. Inflation is just going to go up sky high. But the moment inflation starts to peak and inflation starts to come down, which it will, it's a matter of time, that's when the market will rally strongly again. Now, some of you are probably asking, are you sure there's no recession or no recession coming? Why is everyone saying there's a recession? Well, I believe in looking at the facts instead of just listening blindly to other people. So first of all, how do we define a recession? Traditionally, a recession is defined as 2 quarters of negative GDP growth. Traditionally, that's the definition. Now, for the first quarter of the year, the US economy actually dropped by 1.5%. So we have already 1 quarter of decline. So what people are saying is that if we get a second quarter of decline, it's a recession right now. So we don't have that second quarter yet, but the first quarter was a decline. But I've said before in my previous video that the first quarter decline in GDP was a technicality, that the economy didn't actually contract in the first quarter, it actually expanded. 70% of the US economy is made up by consumer spending, and consumer spending actually rose 2.7% in the first quarter. Business spending rose 9.2% in the first quarter. The only reason why GDP showed a decline of 1.5% was because of a technicality, because of a drop in inventories as well as more imports that the US made versus exports. And the reason that happened was because of the supply chain disruptions, where the exports supposed to be going out, or rather the imports supposed to be coming in quarter 4 didn't come in. They came in instead in quarter 1. So because of the delay in the imports, that increased the trade deficit and that turned that first quarter negative. So in other words, if you remove that technicality, in actual fact, the first quarter did not decline. It was an expansion. All right. Now, is there a decline in quarter 2 yet? Is there a projection of a decline? No. But what's interesting is this: even if there is, it's actually not a recession. People are, calling a recession when there's really no recession, at least not yet. Why? Now, the NBER, or the National Bureau of Economic Research, defines a recession as a significant decline in economic activity spread across the economy lasting more than a few months. And they are the official body that declares recessions. And they are saying that the 2 consecutive quarters of decline in GDP is not how it is defined anymore. So in other words, even if we get 2 negative quarters, it is no longer defined as a recession. Let me say that's just semantics. But it's been found in the past that that's not an accurate measure of recession. Recession is when you see companies' profits are falling. The whole economy is going down. People are losing jobs. Question, are people losing jobs? Not really, right? Yeah, companies are kind of like freezing hiring, but jobs are still growing. Unemployment is still low. The economy is still expanding. So there's actually no recession, well, at least not yet. Go to the Atlanta Fed GP Now estimates page and you can see that their forecast for quarter 2 GDP growth, yes, it has been falling. It was initially at 1.9%, but they've been cutting their estimates. So most recently on the 8th of June, their projection for Q2 GDP is 0.9%. Yeah, it's a lot lower than expected, but it's still not negative. It is still a positive number. So that's why I keep saying, if you look at the data, there is no recession, at least not yet. But the market has already reacted as if it has already happened. And there's good news in that, and I'll explain why more later on. Now, if you take a look at leading economic indicators, there are many of them, right? Two of the key leading economic indicators, which are payroll employment in truck transportation and in temporary help services, actually has been rising. In fact, it rose to a new record in May. So that's the first leading indicator, and that's the second leading indicator, and both have been highly correlated with the index of leading economic indicators. So in a recession, employment payrolls go down. It's not happening. Payrolls are still going up. So based on this leading indicator, once again, there's no sign of a recession. Now, I believe in not just looking at one data point. If you look at many data points across different parts of the US government. The other thing that you can look at is the Philly Fed State Coincidence Index. This is an index that shows the number of US states that are increasing economic activity. So out of a total of 50 states in the US, how many of them are increasing their activity right now? They are growing right now. The answer is 50. All 50 states are growing in terms of economic activity. If you take a look at history, these gray shaded areas were past recession. So recession over here, recession over here, recession over here, recession over here. You look at history, you notice that before every recession started, there were at least 5 states to see declining activity for at least 7 months. In other words, from 50 states expanding, it always dropped to 45 states before a recession started. Right, so you can see here, it dropped from 50 states to 45 states, recession started. In fact, it dropped all the way down to kind of like 30 states. Over here, same thing. It dropped to 45 to 40, recession. Dropped to 45, it dropped to 35, recession. Dropped to 45, dropped to 30, recession. Over here, dropped to 45, 35, recession. So it always dropped below 45 states before a recession happened. We're not there. So currently, all 50 states are growing. We need only 45 states or 5 states to decline before we see a recession. This is not happening. So once again, I want to reinforce the point that there is no recession, at least not yet. Now, I'm not saying that there will not be a recession. There could be a recession starting next year or the year after that. And the main thing that would cause the recession would be, if you ask me, oil prices. So historically, whenever oil prices got too high, it created an oil shock, and that created a recession. Why? Because if oil prices get too high, people pay too much for gas, they've got less money to spend on other goods and services, so companies' profits will fall, and that triggers a recession. So in other words, high oil prices drives inflation, creates demand destruction, reduces the purchasing power and the spending of consumers, and that creates a recession. So historically, you can see that every time oil prices double, all right, every time it doubles from its 5-year moving average, it always ended with a recession. So you can see that this dotted line represents oil prices going more than double above the 50-year moving average. So you can see over here, it crossed a dotted line, recession. This blue shaded area is recession. Recession, right, went above the dotted line, recession, above the line, recession. Well, this one started a recession without that, because this recession was started by the dot-com bust. So it was another reason, right? Same thing over here. All right. So where are we right now? So currently right now, you can see that we are not there yet. Okay. So oil prices are still climbing. And if it keeps going up, yes, it could lead to a recession. Next point. Now, the next point is a lot of people are seeing that things are slowing down, right? So the housing market in the US looks like it's going into a recession. Mortgage demand has fallen to the lowest level in 22 years. Because with rising interest rates, people are now thinking, hey, I don't want to buy a house anymore. I don't want to remortgage my house. And so that's coming down. So housing prices are coming down. So that could trigger a bigger recession. That's possible. If you've also been reading, Walmart and Home Depot, especially, they announced really bad earnings. Because of high inflation, their costs went up, their profit margins dropped, and at the same time, they have got excess inventory. So people cut their spending on high price purchases, and now they are forced to discount their goods. Now, so is this a good thing or bad thing? So on the one hand, you can say it's a bad thing, right? Because, it's showing that the companies are not doing well. Companies' profits are falling, right? Mortgage demand is falling. But on the other hand, what's the good news? There's always a silver lining. The good news is that if the housing market is cooling down, if companies have no choice but to discount their goods and services, that causes deflation. That will bring down inflation. So in a way, this is good, right? Because this means that in the next few quarters, we will start to see inflation coming down. And the moment inflation comes down and the Fed stops raising interest rates as much as the market is pricing in, that's when the market will start its bull run. That's when we're going to have hallelujah. The market is going to go up. It's like you go to the exam and you find that, hey, the answers are simple. It's not as bad as I thought. So there's always a silver lining, right? And you also read recently that Tesla, they said we're going to cut 10% of our staff. Apple, Microsoft, Intel, they say we're going to freeze hiring, going to not hire too many people. So again, all this will start to loosen up the tight job market, right? Which in a way is good because that may cause salaries to come down a bit. And again, that is a deflationary feature. So bottom line is yes, we have officially entered a bear market. The S&P is down 22% year to date and the Nasdaq is down a lot more than that. But I think that a lot of the bad news, the fact that the Fed's going to raise interest rates up to 3%, that we're going to have a recession, all that bad news has already been priced into the markets. In other words, the market already expects all this shit to happen. So if it doesn't happen, if the shit doesn't happen, or the shit happens less than feared, then we are going to get a bottom and we're going to have the next really, really strong bull market rally. Now, exactly when it's going to happen, I don't know. I can't predict for certain. It could be, the second half of the year, which is still possible, or, next year. But in the very short term, in the next 1 to 3 days, I do expect another bounce because the markets are very, very oversold. Again, if you look at the fear and greed index, we're at extreme fear right now. And if you take a look at the price action, we have had 1, 2, 3, 4, right? Sorry, 1, 2, 3, 4. We have got 4 consecutive down days of more than 1%. Now, that's pretty rare. Dropping more than 1% for 4 days in a row, it has only happened 9 times in the last 60 years. And you can see that it happened in 1962 twice. Whoa. 1987, 2002 twice. 2008, 09, 15, 2018, and right now, right here. Now, the only one that was worse than 4 consecutive down days was 2008. That was the financial crisis when the banks almost went bankrupt because all their assets were toxic, worthless, right? We're not in that situation right now. Don't worry, right? In fact, banks are very strong right now. They are well capitalized. So at that time, there was actually 7 straight days of 1% decline. That was really bad, right? But like I said, we're not there in terms of the economic systemic risk, okay? So what happened when we had 4 days of 1% declines? You can see in 100% of the time, 12 months later, the market was up significantly. 12%, 29%, 22%, 23%, 32%. Well, this sucked, only 6%, 59%, 16%, 37%. So if you average it, you can see that the average is 26.7%. So in other words, things look really bad right now, but it's so bad, it's good. It's like what one of my girlfriends said in the past. Adam, you're so bad, you're good. That is so bad, that's good, right? So in other words, if you buy great company stocks right now, companies that are making money, generating free cash flow, it looks scary because it keeps going down, right? But if you buy it right now, like I've been buying yesterday as well, 6 months, 12 months from now, there's a very high chance, in fact, historically 100% chance, you are gonna be happy. It's gonna be a lot higher in 12 months than where it is today. Because remember, what goes down will always go up, provided they are good companies. So see you guys in the next video, and may the markets be with you always. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.